This is Mercer Bullard, Director of the Business Law Institute at the University of Mississippi School of Law. This video is part of our series on the basics of accounting. It covers the calculation of costs of goods sold, which is an expense in the statement of income. This video assumes that you are already familiar with the fundamental equation underlying the statement of income, profits equal revenues minus expenses, and understand where COGS fits among the elements of the statement of income. This is an income statement that highlights the four main categories of expenses. Our focus here is the cost of goods sold, or COGS. COGS includes direct expenses of producing the company's products or services. This would include the cost of raw materials used to make goods that the company sells, and the cost of purchasing and maintaining the machinery used to make the goods, and maintaining the manufacturing plants where the goods are produced. It also includes the payroll and benefits for employees who produce the goods the company sells. Let's assume that the widgets that the widget company makes are staplers. If the cost of making the staplers sold is always the same, it is relatively easy to determine this expense. If each stapler cost $5 to make, then you simply multiply the total number of staplers sold by $5. But probably not all the staplers sitting in the company's warehouse did cost $5 to make. Perhaps 7 of them were made before workers were given a raise, and they actually cost only $3 to make. 7 were then made for $4 each, after which the cost of materials increased, which raised the cost to $6. The cost of heating the plant where the staplers were made increased, while the last 7 were made, which raised the cost to $7. The average cost of making the 28 staplers shown here was $5, but no single widget actually cost $5 to make. If we sell 10 staplers for $10 each, that does not tell us which staplers we should treat as having been sold so that we can determine the cost of goods sold. Before we answer this question, let's think about why this matters. Let's assume that we use the average cost for all the staplers sitting in our inventory. We add up the total cost of making the 28 staplers sitting in our inventory, which is $140. Divide that total by 28, which is $5, and multiply by the 10 staplers that we sold. Our COGS is $50. Subtract that from our revenue of $100, and we have gross profit of $50. We will owe taxes on our profits. We want to consider whether taking another approach might lower our taxes. If we assume that the earliest staplers manufactured were the ones sold, then the first 7 made will have cost $3 each for a total of $21. And the next 3 will have cost $4 each for a total of $12, bringing our total cost of goods sold under this approach to $33. Our gross profit will be $67 instead of $50. This will increase our tax liability, not reduce it. Let's assume that the last staplers to be manufactured were the ones sold. Then our COGS will be higher. The last 7 cost $7 each to make, and the last 3 before them cost $6 each to make, for a total COGS of $67. Our gross profit will be $33 instead of $50. Lower profits means lower taxes. To summarize, we have 3 approaches to determining the cost of goods sold. We can use the cost of making the first 10 staplers, the cost of making the last 10 staplers, or simply use the weighted average. These approaches are known as the first in, first out, last in, first out, and weighted average methods for determining the cost of goods sold. This slide shows the different entries for COGS under each method. Each method will result in different net income for the period measured. A company that uses LIFO and FIFO will keep track of their inventory based on its cost, which will allow the company to identify the first made and last made for purposes of calculating COGS. This is not possible in some cases, such as when the company doesn't have the systems to track this information, or the goods cannot be easily differentiated, such as when a farm keeps adding grain to a silo, There's no way to know which grain was sold. In this case, a company would use the weighted average method. To calculate the weighted average, we will allocate our stapler production between years 1 and year 2. We will assume that the first 7 staplers are produced in year 1 for $3 each, for a total inventory of $21. No staplers were sold in year 1, so our starting inventory at the beginning of year 2 will be $21. We need to add to that amount the total dollar amount of new inventory added during year 2. Here's the timeline for the staplers made in year 2, which shows that the company spent $28 creating the inventory in the first 4 months of the year, $42 in the second 4 months, and $49 in the third 4 months. The total amount spent creating new inventory during year 2 was $119. We add that new inventory to the old inventory carried over from year 1 to get current inventory of $140. To calculate the weighted average COGS, we divide the current inventory of $140 by the total number of staplers. And that would be the 28 staplers, which gives us a weighted average COGS per stapler of $5. If 10 staplers were sold that year, we would assume that under the weighted average method, the COGS for each stapler is $5, or $50 for all 10. That amount will appear in the statement of income, and the same amount will be deducted from the inventory on the balance sheet. Let's now retrace our steps by working through changes on the balance sheet. COGS appears on the balance sheet as inventory. At the end of year 1, the company had created $21 of inventory. It had not sold any inventory, so the inventory entry is $21. As the company creates new goods, inventory will increase. As it sells goods, inventory will decline. In year 2, we know that the company spent $119 making 21 more staplers. We need to add $119 to inventory. But where did that $119 come from? It represents the using up of other assets. Here, we will assume that the $119 represents $50 of raw materials and $69 paid to employees out of the company's cash. These amounts are deducted from the raw materials and cash entries. You should recognize this as double entry bookkeeping at work. Here is our revised balance sheet. A company won't stay in business long without selling the inventory it makes, so we need to make a few more adjustments to the balance sheet. The company sold 10 widgets during the year for $100 in cash, so we add $100 to cash. But it used up $50 worth of inventory using the weighted average method, so we need to reduce inventory by $50, the cost of goods sold. Note that we have increased total assets by $50. So we need to update the value of the company's assets to reflect the gross profit on the sale of $50 of staplers for $100. This creates an imbalance of $50 between the assets on the left side of the balance sheet and the liabilities and shareholders' equity on the right side. So we add $50 to retained earnings to represent the gross profit of $50 and adjust the total for liabilities and shareholders' equity accordingly. Here is our final balance sheet. The key here is to note the relationship between COGS and inventory. The starting inventory for year 3 will be $90 because we started year 2 with $21, added $119 worth of goods, and sold $50 worth of goods. Inventory is increased by the amount spent creating inventory, and it is reduced by the cost of inventory sold. If we ignore other operating expenses, interest, and taxes, when inventory is sold for more than its COGS, retained earnings will rise. When inventory is sold at a loss, retained earnings will fall. Returning to our income statement, the entry for COGS will be the cost of creating the goods sold. which depends on the inventory method used. We use the weighted average method, so $50 in COGS would be deducted from revenues and from inventory. If FIFO is used, only $33 would be deducted from revenues and inventory. If LIFO is used, $67 will be deducted from revenues and inventory. And retained earnings will be affected as well. This concludes our discussion of COGS. You can see why COGS is the trickiest component of the income statement. It involves a somewhat complex interaction between the income statement and balance sheet. COGS depends on the somewhat arbitrary selection of the inventory method, FIFO, LIFO, or weighted average. You should now be able to apply each method and understand how COGS can be manipulated for the purpose of increasing or reducing earnings for a particular time period. Many analysts believe that the statement of cash flows, which is our next topic, is far less susceptible to such manipulation.